This video will go over the OneAmerica Asset Care 1 long-term care illustration. This is their whole life-based combo product, and we're actually going to look at two different illustrations, which are just two different methods of getting basically the same long-term care benefits. One uses an all-base contract, that'll be the one on the left side, and the other uses a extension of benefits rider to give the same total months of coverage. That will be the one on the right hand side. We're going to start over here on the left, and we can see that there are 7 total pages versus 12 for the one on the right, so the 7 pages will be the base contract. First page is the cover page. The second page gives us our overview of benefits. If we look up here, we see an $85,097 single premium, which buys $150,000 of death benefits and gives us 50 months of $3,000 a month for facility care and home care. We have a waiting period of 60 days. That is 60 days for either facility care or home care. On page 3 of the illustration, we see once again the single premium amount stated, and we see this 2% of death benefit. So we had $150,000 death benefit. This is going to pay 2% of that out for long-term care benefits, which 2% of $150,000 is $3,000 a month. The next page is just additional definitions, followed by the summary page with signatures. And we're going to now focus on the ledger illustration, which is page 6 of 7. So once again, we see our single premium contract premium amount of $85,096. We have a cash value accumulation column, which really is not relevant to this particular illustration because the surrender value is actually higher. So if you surrendered the policy, you can see that you would get your premium back in all years. And as we get up here to the 8th policy year, you can see that under the guaranteed interest and insurance assumptions, which is 4% on the interest, that the cash value, surrender value, will increase to more than what you've paid in. In fact, 10 years down the road, it would be worth $91,000, and 20 years down the road, it's guaranteed to be worth at least $113,000. This does make this a money market alternative in certain scenarios. And then we can see the death benefit over on this side, which is not just the death benefit, but it's also the long-term care benefit balance. So we put $85,000 in, we have $150,000 worth of long-term care funds available. And the last page is just a continuation of that all the way out through age 121. All right, now let's compare that to our other option. In this case, we're going to make a premium, we're going to compare the two here side by side, of $43,634 into our base contract. And this is going to buy half of the death benefit. So instead of $150,000, we have $75,000 of death benefit. We're going to pay out the long-term care benefits in half the time, 25 months. So instead of 2% being paid out, we're actually going to have 4% paid out. We get the same amount of long-term care benefits in either case. And basically, let's say that we had a long-term care need that starts 10 years after the product was sold. On the left-hand side, you'd get $3,000 a month, and on the right-hand side, you'd get $3,000 a month. The difference would be at the end of 2 years and 1 month, this contract has used up all the base policy benefits and would then go to the extension or continuation of benefits rider. So we have a single premium amount for that particular rider of, let's call it $15,000. The total premium is going to be the rider single premium versus the base contract single premium, and is about $58,500. If we flip to the very last page of the illustration, which is page 12, there is a premium summary that shows total premiums paid. Here's our $58,500, and is made up of the base policy premium plus the optional rider, which extends the benefits for the additional 25 months and that particular premium. The cash value summary that's on this page is pretty much meaningless because it's not equal to the surrender value, and there's 2 columns in case you're using a current interest versus a guaranteed. We're running all these just showing the guaranteed interest. I'm going to go back up to this page 2 and flip down to page 3. And I want to compare once again with the other base policy only contract. So now we see on the left side our base policy contract of $85,000 single premium, and on this side our $43,000 single premium. We have an additional thing that says contract premium includes $1,085 for the enhanced LTC monthly payout. This is an expense that is part of this initial single premium and gives us a 4% payout versus our 2% payout. So this comes into play when we start looking at the return of premium surrender value in a moment. That page is followed by more definitions, and it's also followed, just like the other one, by the summary and the signature page. So now let's look at the ledger illustration and let's compare the two of them side by side. On the left-hand side are $85,000 single premium, and we get $85,000 every year. On our right-hand side, we have a $43,000 base contract single premium, and if we look at the cash surrender value, we'll see that it dips slightly. It's just several $100s that it dips, but there is this dip, and that is due to the fact that instead of getting it paid out 2% a year, we're paying it out at 4% a year, and there was a partial charge for that. So we do have return of premium on the base contract, but it's not exactly equal to the premium every year. But you do see that in year 10 it started to go up, and in year 20 it's $56,000, almost $57,000, which is very close. In fact, in year 22 it surpasses the total premium that we've paid in. So if the client waits long enough, they can get back all the money that they paid in on a guaranteed basis. Once again, the death benefit is $75,000 on this one versus $150,000 on the other one, which also explains why the premium is so much higher, $85,000 versus what is actually $58,000. So we continue that on out through age 121 on our ledger pages, and now we get into the rider explanation. So what we see here is the option for 25 months of coverage or lifetime coverage, and we see 3 inflation options: 0, 3%, and 5%. We're using 25% months of coverage with 3% inflation, and there's our almost $15,000 cost for the rider. But you can see what the differences would be when you're using the single premium amounts. The next page shows what the future value of our rider would be because we have 3% inflation. In year 10, instead of $3,000 a month, it would be worth $3,914 a month, and in year 20, the rider would be worth $5,261 a month. This is explained in a little more detail on this year-by-year page, which is page 11, and it shows the same thing. Year 1, let's jump down to year 10, and you'll see that same $39,014 for the rider, and it also shows the total benefit amount of $97,000. The rider starts with a $75,000 benefit and increases every year, and 20 years down the road it's worth $131,000. So in this particular case, we've paid $58,597, and our total long-term care benefit pool in year 20 would be $75,000, that's our base policy, plus the rider, which is $131,000, which gives us $206,000 of total long-term care benefits available in year 20. The only catch being that the first 25 months are paid out at $3,000 a month with no inflation, and then in the 26th month we would start to get our inflated amount, which would actually be somewhere in here, and you would get roughly $5,500 a month of long-term care benefits in that 26th month, assuming you needed to take benefits starting in the 20th year. I know it's a little bit confusing with the base policy and the rider paying out different long-term care amounts, but you do end up with 2 contracts side by side. One is paying $3,000 a month for 50 months with no inflation. and the other is paying $3,000 a month for 50 months with inflation on the second half, or months 26 through 50. And you can see that the cost is considerably different for the two different options. However, the cash value and the death benefits are also considerably different. It's just a question of which one is going to work best for your client in which situation. Our recommendation is that you call the sales desk, explain what you're trying to do, and let them run the illustration so you make sure you get exactly what it is that you're looking for.